All right. Thank you very much for joining tonight. My name is Brian Kahn, and I own a boutique investment consulting firm called Jupiter Peak Financial. You have my email there. You also have my blog where I post some daily commentary on the markets, and I did go ahead and post some charts and market commentary just a few hours ago. So there is an update on today's market action. Let's just go through and the disclaimer very quickly, as we always have to do. I'll let you just read that briefly. And again, this is very important because you are trading a leveraged product, so that's what I always talk about is trading plans. I always mention trading psychology, risk management, money management, things like that, and topics like that. So whether I'm doing a presentation, a webinar, whatever it may be, I always have trading psychology in there. That's obviously one of the biggest battles that every trader and investor has is emotions and discipline. So I will always harp on those subjects. Just again, a little bit about myself. Some of you have been with me before. I'm relatively new with Interbank FX. Some of you can find a lot of the webinars that I've done previously on the YouTube site for Interbank FX. And I also write on their new daily Forex Trading Edge site where there's some commentary, so I post my commentary there as well. But basically what I do is I teach one-on-one with individuals that are learning to trade and invest. I don't just concentrate on foreign currencies. I concentrate on who that individual is and what they're looking for given their account size, risk tolerances, time available to the markets. And so I look at equities, options, and the relationships between Forex because I might be helping someone grow their account with foreign currency trading or option trading. I might be helping someone to hedge their account and hedge their portfolio, and we use foreign currencies to basically hedge if we're in a certain sector like commodities. We can use foreign currencies in those relationships that we'll talk about today. We can also generate income using option strategies. So I don't limit myself to any one strategy or any one market. It really is up to what fits the client best. Today's outline, we're going to talk about fundamental analysis. A lot has changed since I spoke to you 2 weeks ago. We're going to get into technical analysis and talk about major trends, support, and resistance, and then get into live market examples. We'll also always touch on those intermarket relationships, which I was just mentioning, relationships between the dollar and equities. Sometimes there aren't relationships, and we'll notice those as well. And then we'll get into the main part of tonight's webinar, which is placing a conditional order and why it's important, and then putting a stop loss and pairing that with a take profit, and again, why those are important. So let's discuss the current events, and let's go to forexfactory.com. Again, you can see how to do this right through Interbank FX's website. I just already have it pulled up as a website, but this is a free website. It's a very, very solid, strong website to understand the economic data out there. And again, you can get there right through the tools and online tools in that section of Interbank FX's website. So moving into the Forex calendar, it's important to start last week. The first week of every month, we get unemployment data for the United States. How is the biggest, baddest economy out there doing? Leading up to that, we had some data prior to that that gave us employment information. So Monday was Memorial Day, last Monday. Tuesday, we come in after the 3-day weekend, and we get something called Chicago PMI, Purchasing Managers Index. If you owned a big manufacturing company in the Chicago region, you may get a survey of how things are going, not only how things are going and give me a headline consensus, but also give me how your new orders are looking and how your employment gauge is looking. Well, the headline number came in well below expectations. 56.6 versus 63.8. The new orders index came in lower than expected, and the employment component of it came in lower than expected. Consumer confidence, lower than expected. Wednesday, we get the National Manufacturing Index, not just the Chicago region, the National Manufacturing Index. 58.1, nope, sorry, it came in at 53.5. New orders came in lower than expected. Employment gauge came in lower than expected. So this is what I mean by if you have a portfolio out there and you're paying attention to this economic data, are you maybe going more to cash? Are you keeping 100% invested in equities and mutual funds and IRAs and things like that? but you can learn to play defense. How can you do that? Understanding relationships between which way the equity markets go and what the dollar does. Understanding that the options market can provide defense by buying puts, and if the markets go down, your puts make money. Your portfolio lost value, but you buffered it. You're basically becoming your own hedge fund. You're managing your own portfolio, some part of it, or maybe if you have your portfolio invested with some investment manager, great, but you can still trade around how your core portfolio looks. So this data was important, and I'll show that to you in the charts in just a moment. Thursday, unemployment claims. Expected 416,000 new people asking for unemployment benefits, came in at 422,000, and this number has been climbing and climbing and climbing and climbing. Let me try and bring up this chart. Sometimes it takes a little while to populate, but it is important for you to see, so I hope it does come up. The point is, over the past 5 or 6 weeks, the expectations for unemployment claims have been at a certain level, and every week for the past 5 or 6 weeks, we've come in above it. So here you have the yellow, which is the expected number. The blue is the actual number, way above estimates, way above estimates, way above estimates, above estimates, just a fraction below estimates, above estimates, above estimates. We get this number again tomorrow at 8:30 a.m. Eastern. We get this number every single week. It doesn't take a lot of work to put this number together and say, are things getting worse? What does that mean for me? If I'm young and in college and I have nothing invested, may not mean as much. Maybe I'm just trading around it. If I'm older, 60, 70 years old, and I'm getting ready to retire, sell a business, cut back on working, relying on Social Security income, relying on my investments, maybe I say, you know what? I'm going to keep them in there. I like the dividends and things like that, but I can play defense. How can I play defense? I can understand relationships with various markets and play the downside a little bit and try and hedge my loss a little bit. So the main thing you have to remember, though, is there's someone lurking behind this economic data, and that is the government. And Ben Bernanke just spoke yesterday. And are we going to get quantitative easing 3, quantitative easing 4? Nobody knows, but a few months ago, when we'd have bad economic data, the markets would go up, because they're going, ooh, yeah, more quantitative easing. And right now we got a lot of data that was bad, a lot of bad batches of data, and the markets finally went down. For the first time since last summer, we've actually gone down day after day after day and really taken back 4, 5, 6, 7% in the overall markets, and much, much larger in certain sectors and certain stocks. So that's why this is titled Back to Basics. Who are you as an individual? How do these market numbers affect you, and how are you going to sleep at night knowing what you have invested in the markets? How are you going to go ahead and try and protect yourself? How are you going to go ahead and profit from this? Every single person is different. That's why when I work with individuals, it's got to be one-on-one, because every single person out there listening tonight is in a different place. And then we fast forward to last Friday. Hey, let's expect 161,000 new jobs to be created. Nope, sorry, 54,000 created. So we're only about 3 weeks away from the next number. So that's coming and lurking just ahead. We have another round of corporate earnings coming up in July. We have obviously the unemployment number, lots more retail data and things like that. So this economic calendar is very, very important to pay attention to. It gives you your fundamental opinion of what's going on out there. And then you can start to use the charts to time your entries, time your exits, manage your trades to the best of your ability. Again, understanding that whatever you're trading off of, fundamental information, technical information, no guarantees things happen like they did in the past. So we always have trading plans. We always have stops in. We know that we are going to have losers in the markets. That's just a fact. It's just a matter of controlling our losses, moving on to the next trade, hopefully having a good opportunity, risk reward, high probabilities, things like that. But we know that there aren't any guarantees out there. All right, so moving on from fundamentals, let's kind of look at the charts and what's going on. So we're just looking at a chart of the S&P 500. All right, this little dip down here was the March low around 125 in SPY, 1250 in SPX. So 1250 down there after everything happened in Japan, climb back up, get all the way up to 137. And then all of a sudden, the whole month of May, you can see in early June, we've really started to crater down. Overall, though, we have to realize that in 2009, the stock market went up 65%. In 2010, the stock market went up 15%. In 2011, we've been up so far. So barely, but we're up. Here's January of 2011, and here's where we're at right now. So we're not up much, but we were up a huge percent just about a month ago. So we have to understand that the markets could fall a lot further. I don't know where they're going. They could fall a lot further and still have done very well for the past couple years. So we're going to be waiting for new news. How are corporate earnings going? How are retail sales going? Are consumers spending money with commodities being higher? Are consumers spending money with the jobless rate starting to climb a little bit? Is QE3 and QE4 going to come to fruition? This is all great stuff that we get to wake up every day and see what's going on and have trading opportunities. Hopefully have trading opportunities. We never know what the markets are going to give us. Again, please, I'm just checking right now. That's why I'm pausing. Please chime in with any questions that you have through the questions tab, and I will be sure to try and answer them. If they're a little bit off topic, I'll let you know that and say, hey, follow up with me after, because it may not be on the subject tonight. Something important to remember, and this is where we look for opportunities. The stock market, we were getting bad batches of data right in this area last week and about a week and a half ago, and the stock market, the S&P went from 131-ish all the way up to 135-ish. $4 of $131 stock is 3 or 4%. An unemployment report was coming out basically right here. So what we were doing is heading up before it on the heels of bad news, and as a portfolio manager, as an investor, you have to say, wait a minute, there's really glaring bad news out here. Do I want to buy some protection? That's why puts are nice, because you can purchase puts in the equity market over against your portfolio and hedge that portfolio loss a little bit. So we know over the last month that most people's portfolios have gone down. People are using economic data and using charting, then they can say, I can try and buffer that loss. So again, you're treating it basically as a hedge. So big move up in the face of bad news. And then if you were expecting the unemployment report to be bad, well, this was a great chance to go ahead and short the markets or buy puts and be bearish the markets, because as the market goes up 4 days in a row, obviously buying puts is a lot cheaper. Moving over into foreign currencies, and again, that's why this is important to understand that everything basically is back to basics. There has been a rough relationship out there that when the equity markets go down, the dollar gets stronger. The dollar is kind of like the safe currency. When equity markets are going up, commodity prices going up, the dollar is getting weaker, because we know gold prices are getting higher, commodity prices are getting higher, energy prices are getting higher. So let's look at some of those relationships. Here's the US dollar versus the Canadian, and let's just bring this down to a daily chart. All right. So over, let's see, April, May this year, you see the US dollar has gotten stronger to the Canadian. We also know that energy prices have gone 115, 110, 100, 99, 98, 97, and they're hanging right around 100 today. So if you were heavily invested in commodities or energy stocks, or maybe you just hold oil futures, then you can use it as a hedge by understanding maybe that it's a cheap place to buy the US dollar against the Canadian dollar as your hedge. Again, just trying to see where you individually might have a lot of risk and exposure, and maybe you're really bullish oil, you don't hedge yourself. Maybe you're bullish oil but not so much anymore, and maybe you chose to hedge yourself using puts over in buying puts on USO or any of your stocks that you own, or you could just go in here and buy the dollar when it was cheap and obviously try and get a rise up. Again, there's no guarantees that these relationships are in place, and that's what I want to show you right now. Typically, like I said, when the stock market goes up, other currencies against the dollar go up. When the stock market goes down, other currencies against the dollar goes up, basically, against those currencies. Well, the stock market's been going down for most of May and June, and look what the euro's been doing against the United States dollar. It's been going 139, 140, 141, 142, 143, 44, 45, 46, 47. It gained almost 800 pips in the same exact time that the stock market was going down. So back to basics, what's driving this, big rally in the euro against the United States dollar in the face of the old relationship where equity markets down, dollar up? Well, here's equity markets down and dollar down. So back to basics, what's driving the euro versus US dollar? It's very different if you look at this against, let's get that back up there. It's very different if you look at the Great British Pound against the US dollar on the same time frame. The Great British Pound has basically had a little bit of that move, but definitely not as severely, okay? So it's definitely kind of gone, but basically of the two, you could see that the pound hasn't climbed back as much as the euro has against the dollar. So if we were to look at the euro versus the Great British Pound, you could probably infer from that that the euro is going up from the against the Great British Pound. And I was going to actually try and pull that up right now. If we can find the euro Great British Pound. Let's see if I inferred right, because I don't trade the euro versus Great British Pound, but we're going to try and find it right here. Okay, so there's the euro over the Great British Pound. Let's get it right here. So there it is on a daily chart. Over that same time frame in May, look what the euro is doing against the Great British Pound. It's going from 86, 87, 88, 89. So it grabbed pips, it grabbed pennies against it. So you can see that, obviously, understanding those relationships against other currencies. Let's see, I'm just going to try and get to a question here. So guys, thank you very much. Considering the markets are up only because of QE, and that's a ton of money to move the market so little, would it only be common sense the markets will dive if QE3 is delayed? That's a great, great question, and thank you. And I think that's perfectly on topic for where we're at right now. I actually talked about that in my blog earlier today. That's the big question. Is, again, I don't know who's asking this, and I don't know where you're at in life and what you have invested in the markets. And the more you have invested, the more you're relying on that. Yeah, it's got to make you take pause. Someone else might say, I have nothing invested, I'm just younger, or maybe I just have most of it in my trading account, and they might say, good for QE3 because I think it's going to be a disaster. It might be great for bond prices going up. It might be great for so I can borrow money cheaply and stuff like that, you know, and refinance my home again and again and again, but I'm not convinced it's going to make the markets go up and it's going to make an increase in volatility. So as a trader, it's going to be great. As an investor, I'm not so sure it's going to be great this time, but we don't know, right? None of us know. We'll have to wait and see what the traders do with it. And that's the great thing about using charts is we can basically go ahead and say, hey, here's the fundamental news that came out. They're buying it, you know, QE3, and they're buying the crap out of it. It's time for me to take off my protection if I was hedging. You know, so we don't know yet, but that's a great thing about understanding charts. Charts are our lifeline, and so we use the fundamental news. Then we say, here's what it was, here's what they're doing with it. Like I said, we used to get bad fundamental news, and the stock market used to go up and up and up and up. And anybody who didn't understand that, it's like slicing your wrist open with your keyboard if you're trying to sell into the equity market when it goes up 1%, 1%, 1% day after day after day after day. So we've got to be true to ourselves and let the charts tell us what to do. All right, so very, very good question. Thank you for that. And that's the whole point, is technical analysis. We can see that the euro has been going up against the U.S. dollar, and if you're trying to go against the euro, then you have to pick your certain location, your certain, whether you use Fibonacci relationships or retracements, whether you use trend lines, whether you use moving averages, doesn't matter what it is. If you're wrong because it went through your trend line or went above the Fibonacci retracement you liked or went above whatever indicator or chart pattern or double top you're using, then you go ahead and get out, take your small loss onto the next trade and look for another relationship. So again, it's all about trading plans because there's no guarantees out there. We do the best we can and try and find the best location we can. So let's get into the meat of tonight's lesson. But very, very good question. That's the kind of stuff I like to see up there. So again, Forex Factory, time that with CNBC. You don't have to stare at a computer screen. Make sure you turn on CNBC because they're going to be reporting our unemployment claims number tomorrow, our inflation data, all that kind of stuff. So we just do our homework. Hey, what's coming out tomorrow morning? Okay, at 6:30 in the morning Mountain Time for me because that's where I'm at. I want to make sure that I'm up watching the unemployment report. I might not necessarily trade off of it, but I just want to know what's going on with unemployment claims. Bloomberg has a great website. Your broker, Interbank FX, lots and lots of good education. You guys probably all know Raggy Horner. She writes commentary. She does webinars. So lots and lots of good stuff. I'm hopefully providing you guys with some worthwhile education. And then, as you know, just the internet is, in general is solid. You can go and find books on any subject out there. So lots of help out there. So what are the traders doing with the fundamental news? That's what I was just mentioning. What are the major trends, support, resistance? These three words are key. I'm going to go into those over the next few webinars. We're going to go into trend in detail for short-term and long-term traders. We're going to go into support in detail. We're going to go into resistance in detail and look at some really cool, fun opportunities over the next few weeks together. Again, intermarket relationships, sometimes they're there, sometimes they're not. It's so nice to be a trader and say, because of this, this should do this, and it's what we call an ancillary market. If the stock market's going this way, the dollar usually does this. I know that I want to be a seller or a buyer of the dollar based on what the stock market's doing. Like I said, back to basics. We're in such a weird place. There's so many different currencies out there and interest rate policies that are all over the place. The Australian dollar is at 4.75. The United States is at 0.25. Where do you want to put your money? Probably to get a better interest rate, you could go over and put your dollar in Australian dollars if you live here. So everybody's doing such different things, and there's a lot of pressure on various Federal Reserves. Bernanke here, Trichet over in Europe. Then you have China that's coming along with interest rates this week and stuff. So very, very interesting times. That's why you have to go back to basics and understand a really, really, really good trading plan for what you're trading, whether it's a stock, whether it's an option, whether it's a future, whether it's a foreign currency. All right, order entry. Why is a conditional order so important? It's because you're proving to me, at least, because when I deal with my clients, they email me what they're doing, and we're in touch with each other. We kind of have banter. That's why I write at Finance Banter. We have banter going back and forth. They're telling me their trading ideas. They're telling me their trading plans, and I get to be their second set of eyes, a very, very good, educated set of eyes that are basically kind of helping them. Hey, watch out for this. Hey, don't forget about earnings coming out in Cisco, in a couple of days if you were doing something on Cisco. Hey, we have the beige book coming out in the afternoon. We don't normally get afternoon numbers, but the beige book is coming out today late. If you're trading, be careful of that kind of stuff. So that's what I do with traders, but they also are emailing me their trading plans so I can understand what they're doing and the thinking behind it, and then we can learn from it. This is a great order setup so that I know that they're thinking through the trade. So let's go ahead and place it. I'm just going to check and see if there's any questions really quickly. Thank you very much again for that question on the quantitative easing. That was fantastic. So let's go in and let's place some orders. So let's just pick a pair. We'll pick the pound. All right, not much going on right now, but we have the pound here. We'll bring it down to a 15 minutes. So that's the other thing is, people ask me when is the best time to trade. Well, we know that right now, basically Asia is getting ready to open. All right. Europe's going to open in a few hours, basically, 4, 5, 6 hours from now. So right now, if you're looking at the pound US dollar, it may not be so active. If you're looking at the yen, the Australian dollar, New Zealand dollar, stuff might be a little bit more active. So I live here in the United States. I know what's going on here. I try and pair that with some other currency. I don't really like to trade two different currencies that I don't live in against each other. It's just not my thing. That's just me personally. But again, that's not to say that there's great opportunities and great markets out there and great movement. So you just have to pick what your comfort level is. So right now, again, we're not worried about profit or loss or anything like that. Here's the pound running up. We could say that it ran up to old resistance up here, and maybe we want to sell it short up there. So what I do is I right-click, and it brings up my trading window, and I go to a new order. All right, so we're going to do a couple things here. Do I want to do it at market? Market means go right now. No, I don't want to do it at market. I want to make this a pending order, and I want to sell it short. I think it's going to go down off of resistance. So basically, I'm going to press sell limit. Just remember what sell limit means. A sell limit means I'm willing to get into the market if the markets come up and fill me at this level, but that limit order basically, or contingent order, we don't like to use limit, it's really contingent order. That contingent order is going to turn into a market order. So that where I said I want to get filled at is going to be very different by the time it goes from contingent sell limit into market, and then I don't know where the bid ask is there. So I'm just basically saying in this area, I like it. But remember, I talked about average trading ranges, which is just posted on YouTube in the last webinar. In the average trading ranges, the more volatile it gets, the faster the markets move. I might have to compensate and trade less contracts and have a bigger, wider area that I'm willing to get filled and put my stop in above. Instead of doing 10 pips of loss, I might do 15 or 20 because it's more active, but I might do less contracts. I'm still going to lose the same amount. I'm just going to space it out over a longer, maybe a little bit longer time frame, maybe a little bit longer period of pips, basically. So we're going to sell the limit. The price, well, I see the price basically right here around 64.11 or so. I'll just put it just above the markets, 64.15, because remember, I'm thinking the markets are overbought. They're going to come up to my level, get me, and then hopefully go back down before going up to my stop. I can't place it yet because I haven't done my take profit and stop loss. Traders like routine, just like football players. Hey, I put on my left sock first, I put on my right sock second, whatever it is. I always go for loss first because loss is important to me. I'm not worried about the winners. It'll take care of itself if I'm going to have a winner. But I don't want to just be stupid and have a loser that I didn't know what I was doing, why I was doing it. So I always go for the stop loss first. So if I'm selling it short at 64.15, I'm going to have a loser if it goes higher. 64.30, let's say. I'm willing to lose 15 pips. Okay? Take profit. If I'm willing to lose 15 pips, I want to make 20 pips. So 63.95. 1.6395. All right. And now I'm going to place it. All right. I'm in. Here's where I'm willing to get filled. At 64.15, sell limit. 64.30, you can barely see up here at the red line. I'm willing to take a loss. And 63.95, I'm willing to take a profit down here. So until remember, I'm trying to sell something here until the bid comes up here and matches, because just like buying a house, someone has an offer and you're bidding down here, and you guys don't have a deal until the offer and the bid reach the same price. So until the buy price of the Great British Pound US dollar hits 64.15, I don't have a deal. What does that mean? If the bid is at 64.15, boom, contingent order turns into a market order. It may have turned really quickly and gone 64.16, 64.17. I may have sold it short a little bit higher, a little bit lower. I don't know. But remember, I'm down pips right away because there's a spread, and you can see that right here. So pretend that this spread right here is at 64.15. The bid is at 64.15, but the ask we can see is about 3 to 4 pips away, basically. So there's a 3 to 4 pip spread here. That's including my commissions and things like that. And there's just a spread and commission in any market you trade. You don't get around that. That's just a fact of life. So I know that I'm down 3, 4 pips right away. So for me to make my 20 pips of gain, for me to get it to go from 64.15 down to 63.95, if I'm trying to sell something short and buy it back, I don't need the bid to get down here. I need the ask to get down here. So I get filled at 64.15 when the bid hits it. The ask is at 64.18, let's say, if it's 3 pips. Now I need it to go 18 pips down to 64 even, and then another 5 pips down so that the ask hits 63.95. So I'm really trying to make 23 pips or so because of the spread that's locked in there. That's normal for any currency broker, any Forex broker, any market out there. You always have that spread. All right? So that is the contingent order. Selling it at a price where I think is going to be a good area for it to be too overvalued at, turn around and go down. We actually probably would have had a pretty good order in here if we would have put it in, because the bid price just came within a pip of us. But again, we weren't worried about profits or loss. This was just for exercise only. Let me just, before we go into a buy order, let me just go ahead and check if there's any questions. Do you, let's see, do you think Asia is a wise trading zone? It can be, but you have to remember what you're trading. So a little bit off subject here. I don't think I would be trading the pound US dollar during the Asian session. I might bring up, the New Zealand versus the Aussie, that kind of stuff, because their banks are opening, their stock markets are opening, their commerce is open. So it all depends on what your schedule is. Yeah, Forex is kind of weird. Could you come home from your job all day if you work all day and then start trading the Asian session? Yeah. That's hard if you have a family and that kind of stuff. So, that's where people have to be true to themselves. I've definitely told a lot of clients and people like that, hey, just be careful. Foreign currency provides so much good opportunity. It's a leveraged market. It moves well. It has nice moves and retracements and nice chart patterns. We have trading plans built around those, risk reward and things like that, and make sure we're risking the right amount for our account size. You just have to be careful, because you could turn on any time and go make a trade. That doesn't mean that the markets are going to be active right then and there. So you have to have good trading plans. You have to know when to make trades and when it's going. Overall, volatility is down, okay? And so that's something important to talk about. If I go back here to the equity markets, we can look at something called the VIX, which is a volatility index. I wrote on my blog, there's some great trading opportunities out there. They're just, in foreign currencies. They're just not coming as far and fast as we're used to. But this has been like this for quite a while, because the markets aren't as volatile as they were years and years ago. Why? Because our government is saying, we're going to help you out. We're going to help you out. No matter how bad things are going, we're going to help you out. So the volatility index has been getting lower and lower and lower. So let's look at it over the past year, and I'll show you. Actually, let's go to 5 years because it makes more sense. as the stock market has rallied, basically, here's 2009 when we bottomed out in the stock market, and the stock market went up all of 2009, all of 2010, and most of 2011. Here's the VIX going down, 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 went peaking, went back up during BP last summer, went down, 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 peaked here again when we went up in the March episode for Japan, and now we're climbing back up a little bit. But overall, we're still pretty low down here at the bottoms. We can be much higher. So that's something to be cognizant of. Is trading ranges overall are smaller, and I can prove that. This is a daily chart, and basically overall, the daily average trading range in the pound, basically, in most currencies are smaller than what they were, quite a while ago. So look at these. Look at this. This is April and May. Let's see. This is April of 2010 to basically a year, over a year. April of 2010 till now. These bars are very, very, very small. All right. And the stock market during this time, rally, 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 rally. No fear, no fear, no fear, no fear, no fear, no volatility, no volatility. So the bars are smaller. Here you can see, look how big these bars are compared to here. Much, much, much different. And you guys can see that on recent data. Look at the euro. Look at this bar here and this bar. That's when the European Central Bank Trichet, their Ben Bernanke, said, everybody's expecting us to worry about inflation. Nope, we're not going to worry about inflation. And everyone sold the euro because they thought that the euro was going to say, we're going to get stronger and stronger because we're going to raise interest rates. We're not going to raise interest rates. Big surprise, euro weakens. The reason why I'm kind of bearish up here in the euro, well, the euro just climbed all the way back up, and didn't Trichet just here say, we're not going to strengthen the euro? So what caused the euro to strengthen so much here? I don't know, but maybe it's a little bit too high. I'm not sure. Can you create a trading plan around it? Can be a hedge, that kind of stuff. Lots of good opportunity. You just have to be aware of what's driving it and be smart about it, because if you overtrade and you trade in poor locations, you're going to get caught, and it's going to be tough. And that's not what anybody wants. That's not what you want. That's not what your broker wants. They want you to be educated. That's why I'm talking to you. That's why Raggy's talking to you. They want you to be educated. They want you to be a great, great client of theirs. Trade larger, trade in different markets, things like that, trade in different currency pairs. So you just have to be true to yourself and make sure you answer what's achievable to you. That's why I always ask that to traders. Who are you? What's your account like? When can you trade? Do you have a day job? That kind of stuff. Because 20 people tell me they want to be a day trader, and they all raise their hands that they have day jobs. I don't think their boss is going to be too happy if they're staring at foreign currencies during work. It's probably not going to work out. And we know that it's all about productivity right now. So, hey, you're out of here, buddy. You were trading on the job. You're out of here. And thank you very much. We'll hire someone else to do your job. So, yeah, I think Asia is a great trading zone. It just depends on you and your individual, take on it as far as is achievable to you given your lifestyle and things like that, and time frames and things like that. So, getting back into the pairs here, let's go back down to a short-term chart. All right, we haven't been filled. Would have been a nice trade. There's our entry price, and it goes back down. It hit this little resistance part, maybe. Who knows? Again, I wasn't doing it for a trading reason. I was just doing it to show you the order. I need to go down here, though, and I need to find my trading button so that I can clear this order out. So I go down to the very bottom, trade, and I click on this and say, you know what? I missed it. I didn't get filled. It went down basically my entire move I was looking for, and I want to modify or delete my order. Thank you very much. Delete it. It's gone. Okay? Let's go ahead and buy it. It came down. Maybe we think it's undervalued. We're going to go ahead and buy it. So let me blow this up again. And trading, new order. And you know what? Just for execution here, I'm going to do this at market. I'm going to buy it at market. Whoops, I didn't mean to buy it at market. I was going to put a take profit and a stop loss and a contingent order or whatever it is. But you know what? I like this location. I'm going to go ahead and stay in. But I don't have a stop in right now. That's not good. So I go down here to my trading window. And I go ahead and right-click on it, and I want to modify or delete it. I don't want to put in anything except for a pending order, and that pending order is going to be my stop loss and my take profit. So I bought it at 64.05. I'm willing to risk my 15 pips, so I put in 1.6390, if I can do the math. I always do the stop loss first, and hey, I'm willing to make 20 pips. I'm going to get out at 1.66425. There I have it. Go ahead and place it, and now I'm bracketed. Now I have my stop loss and my take profit. Okay? So basically, that's why you're doing it, is because you're saying, you're taking the pause to say, I'm willing to get into the trade here because of this and this reason. I want to have this much of a loss because of this and this reason. I want to have this much of a gain because of this and this reason. I don't care if you're losing 100 to make 200 because you're a little bit longer term. I don't care if you're losing 10 to make 20. The point is, you stopped, you paused, you had the right amount of contracts on given your account size, and you went ahead and had a plan. And then we let the charts update and tell us what to do. And as the chart keeps updating, hey, Brian, it's going the way you want to do. Maybe at some point I've got, instead of 20 pips of gain, I've got 15 pips of gain. Well, you know what? Now I'm not risking my original 15 pips. Remember, I said I'm willing to buy it and risk 15 pips. Well, if it's gone 15 pips to the upside, I'm now risking 30 pips. So I can start to manage my trade by going in here and modifying it, modify or delete order, and I can change my stop. My stop loss doesn't have to be basically where it was. I can always change it. I can change it as many times as I want to. So I don't want my stop loss to be at 63.90. I can put it at 63.95, or let's put 63.96. All right, so I'm moving it up because the chart is starting to tell me, hey, move it up. Hey, take some off the table. Hey, get out of some of it. You know, now you're playing with house money, all kinds of things. So we're always working this order, what I call always managing the trade. I could change this whole thing and cancel my take profit and stop loss, turn it into a trailing stop. I can do whatever I want. The charts are telling me what to do and how to manage the trade. That's the great part about it, is remember, the charts are our lifeline. They're telling us what to do. So I'm just going to go ahead and basically, so if we want to get out of this, basically I just need to close the order, and I'll just close it and take it out. And when I close it, it automatically goes ahead and deletes my take profit and stop loss because it knows I'm out of that trade. So that's the nice thing, is if you just want to get out of the trade, you don't have to worry about canceling those stop losses and take profits. If you just do, I bought it, now I sold it, and it just deleted those automatically. So pretty slick trading entry order. And again, like I said, the most important thing is you're not just, hey, press the market, go, and hey, hopefully it'll work out. I don't have any plan. This is proving to me that my traders, my clients, that they have a plan. Let's see if there's any questions as we get ready to wrap up. Do you think Asia? All right, I think we're good. Let's get back into the slides here. All right, so conditional order, why? Because it's basically setting an area where I think is a good place to get in, and then I'm going to put my stop loss around it and risk a certain amount because that's my trading plan. I'm going to put my take profit around there because based on past performance, I think that this is a reasonable amount of pips to go for. So again, nothing unreasonable. I'm doing it off of the charts. And management of the trade, if I'm going for 30 pips and I have 20 pips in it, I can move the stop order up maybe to break even. Maybe I can put it into 5 pips of take profit, 10 pips, and guarantee myself profit out of the trade. Everybody's a little bit different. Me, yeah, sometimes I take my profits a little bit early, but there's an old saying, you can't go broke taking profits. That's just me. Maybe I don't ride it as much as other people do, but that's just my personality. I like to book profits. Just taking a drink of water there, sorry. Let's go to the next slides to review. We talked about fundamental events, macro and micro events driving markets, such as QE2 would be, or QE3 would be a huge macro event. Unemployment data might be kind of macro, and then you start to get into what did Trichet say over in the European Central Bank, might be micro for the euro, because it might not matter over in the pound or the Australian dollar or New Zealand dollar or something like that. So micro events that affect that currency pair. Technical analysis, what's going on with trends, what's going on with support and resistance. Again, I'm going to hammer trend, I'm going to hammer support, and I'm going to hammer resistance for long-term traders, short-term traders, and for people looking to hedge their portfolios. And we'll look at examples in equity markets, and we'll look at examples in the foreign currency markets. And again, proving that those intermarket relationships provide trading edges. And tonight we focused in on the order entry, doing a conditional order plus a stop loss and a take profit, and we saw how those worked, and they're very, very easy to put in. And worst case scenario, it's kind of like that set it and forget it. if you walked away or got busy or did something else or tripped and fell, at least you always have a stop loss order in there. I can't stress that enough. Next webinar, June 22nd, 2 Wednesdays from tonight at 9 o'clock Eastern. Again, fundamental analysis, technical analysis, and we will focus on trend in detail. You can see all of the recordings. This is my 6th recording with Interbank FX on their YouTube site. You can pick up education there in the website there that they have, and then their new site, dailyforextradingedge.com, where I do try and post daily commentaries. They're basically a subset of my big blog post that I put on my own financebanter.com website there. So I just try and piece some out there for a lot of you guys over on Interbank FX, but either one will get you that story. Again, some of you may have questions that are a little bit off the subject, and so if you want to email me, I'll just flip back. That is my email right there. And yes, I do own, and I'm the VP of Education at Jupiter Peak Financial, working with people one-on-one so that they can hopefully make the most of growth, make the most of income generation, and protecting their portfolio given their specific situation. So let me just check one last time if we have any questions. I think that's it. I thank you very, very, very much for attending tonight. I look forward to speaking with you again in 2 weeks. And if you have any questions, please feel free to get a hold of me. Thank you, everybody.